Good evening.
Hey
What up,
Isaac, how
Tanisha?
you doing?
Hey, Sharonda.
Hey Sharonda.
Good evening, everyone. I see we got folks coming on in as we speak. I hope everyone is warm. How are we
It's much
doing?
better
Sharonda, I
inside, I'll
think
tell
you
you
you may
that
be on mute if you got anything to say to this cold weather out here, because we got to
much.
talk to this cold weather.
I don't know what we gonna say to it. It's stubborn. It's gonna be here for a minute, at least this week. Walking the dog ain't no joke. This is the one time I feel like I want to get rid of him, but I love him though, so I can't get rid of him.
The sacrifices we make.
Yeah, right.
Yes.
And he's spoiled and he bad. So what do you do? I don't know.
Well, yeah.
I got a little Pomeranian. He's another kid. Mm-hmm.
That's
It
right.
is how it is.
Oh boy, you got. I had a so unfortunately our dog is no longer with us.
Sorry to hear
But I
that.
do remember, yeah, he lived a long life now. He lived a long life
Mm-hmm.
to the point where you say, go sit down. He'll walk around where he need to sit. He'll do about 3 laps and just look at you, lap around, look at you again, and then you
Yeah,
sit down like, man, hold on, man. You know instructions. So it's that cold weather always shows just another level of care that you got to take because if you got to
yeah,
go outside and leave
absolutely.
him, hey
Mm-hmm.
now, hey, you don't need to start paying some bills. Okay, so
Well, mine
uh
don't. He don't like to go to the crate, so he likes to look at me like, "Why am I in here?" And he talks back, like he argues with me.
you got a true relationship. True
Yeah,
relationship.
absolutely, absolutely. Like we're gonna have with our participants today.
That's right. That's exactly right. And so let's make sure everybody, let me see, we got folks coming in. Let's make sure y'all text your friend and don't lean on, hey, it's gonna be recorded. Watch it later. Yes, you can, but it's one thing when you receive a meal fresh, right? Like we don't want you to put it back in the microwave. We want you to get it fresh off the plate, get all this great information. And so we're really, really excited about Sharonda's time, Tanisha's time, because it is very important that we continue to bring this good information to you because unfortunately in today's climate, it may seem like opportunity may not be in front of you. But as we learn more about information, some of the ways to be able to mobilize either, hey, I want to become a homeowner at some point, you may be closer than you think. And that's the one thing that we've seen even from last year's workshop to till today is that there are folks that are a lot closer than they think. And so do you want to do a quick introduction, Sharona Tanisha, and then I will share screen and we'll get right into the information. Let's see. Y'all gonna do rock, paper,
Sure,
scissors, or
Tanisha,
gold?
you want to go first?
I'll go. Good evening, everyone. I'm Tanisha Derrico, the Business Relationship Manager for Hope Credit Union here in the Birmingham area. And I'm so happy to be here with you guys tonight.
Thank you. Thank you.
And I'm Sharonda Sullivan. I'm also with Hope Credit Union. I'm on the mortgage side, and I am looking forward to just educating you and answering all your questions to help you with financial wealth, along with Isaac.
Excellent. Hey, look. I'm just here to keep the show on the road. I'm just gonna hit next on the slide. Y'all gonna drop all this gems and free jewelry. So again, make sure y'all share with your colleagues. Home ownership is an aspect of life that usually reflects the biggest asset that we're able to develop in our personal balance sheet, right? And so this is a beautiful opportunity to be able to learn about not only the bank itself, because you got to make sure you got a strong banking relationship wherever you're doing your day-to-day operations. But alongside that, as you have a strong relationship, there are additional opportunities to be able to utilize products or just additional support on some of the things that you're looking to get accomplished. So our chat host will be joining us shortly. Candace will be here to provide some additional information. If you have any questions, this is the time to be selfish. Just like when we had Megan with the student loan. Hey, y'all jumped off mute real quick. Hey, I got a question. And so let's make sure that we lock in and we take advantage of this opportunity. And we're going to jump on in. Oh, so I'm going to share screen. And then, ladies, I'm going to let y'all take it from there. Boom. Let me do full screen. Hold on. Let me not. All right. Let's do a little bit of view, full screen. All right, that should be not it. Slideshow. Let's do it like that. There we go. There we go. There we go. Okay. I'll let you all go first.
Tanisha, did you want to say anything about Hope on the banking side first?
Yeah, absolutely. So we were fortunate enough to have our open house today. We have a new branch over in the Roebuck area. I would love for you guys to come and see us, 9178 Parkway East. We're right in front of Walmart, so please come and see us. We would love to assist you with opening an account with us. We have several checking and savings accounts for you guys to choose from. So come and see us. Any of your other lending needs. We know times are tough in this climate, but we're help to alleviate some of those things. So absolutely come by and see us, 9178 Parkway East.
Thank you for that, Tanisha.
No
So
problem.
Tanisha is actually on the banking side. I'm on the mortgage side, but we actually partner together. A lot of things that we talk about today about credit and getting you ready will also involved if you're looking to repair credit or just build credit. There are some not documents, I'm sorry, products that they have on the banking side that can actually help with increasing your credit score or just building credit. I also have things I think for teenagers to kind of help them get started with financial wealth. So just ready to educate and get you guys ready and set up for financial wealth. So some of the things that we're going to go over today is the cost and responsibility of home ownership, exploring the loan process and the repayment process, and also learning about just financially getting you ready to own your home. Usually when I talk to my clients, I like to talk to them and got to kind of get them ready a year or two before. And I know that sounds like it's far out, but that also helps you understand the process of owning a home, budgeting and things like that. So that's why I always say it's kind of good to kind of start out a year or two before, because I have people that come to me when their leases about up in 30 days, 60 days, and it's kind of hard to get you ready, and that's a short amount of time when it comes to mortgage. It takes 30 days to even get you in a home, and sometimes it can take you longer depending on the process and your situation. So I always say start working on that a year to 2 years before it's time, and that way you'll be kind of ready to step your foot in the water and get going. Because once it gets going, it kind of takes off, and sellers they're ready within 30 days, 45 days, whatever that contract says. So it's kind of like getting on the racetrack and moving along. You can go to the next one, Isaac.
All right. And then really quick, as we go to the next slide, I know we may have folks on the Zoom that may say, well, I bank with Wells Fargo, I bank with Regions. Can you quickly share some of the benefits of being able to have a relationship with a credit union like yourself? And I know we'll get into some of the features that come alongside it, but just kind of just high level. Yes, we are a bank as well, but this is part of the reason why you would want to get some support with the credit union or relationship.
Yeah, I'll speak to that. So just with a credit union, when you become a member, you're a part of owner of the credit union. So the credit union is owned by its members. You receive dividends and you show true ownership in it. And it's our relationships. We value our members. So I will say the relationship aspect is very different. Of course, we pay you dividends on your checking and your savings account. And then we do have better rates, I would say, than a traditional bank. So we are a financial institution. We are insured by the NCUA. So you get that safeguard there. But definitely the relationships and the competitive rates, you won't really find anywhere else. And I will say along the lines, we're not strictly a yes and no type of financial institution. We're willing to work with you. Like Sharonda said, we're willing to say, hey, not right now, but that doesn't mean no. It's just not right now. Let's work on some things. Let's get you to where you need to be in 2 months, 3 months, 6 months, so we can say yes to whatever your loan needs are, whether that's for a mortgage or a car loan, any of that, we're willing to work with you and stick with you. So I'll say that's one of the major differences.
Excellent. Excellent. Thank you.
And actually, to speak on that too, on the mortgage side, we're looking to make it affordable, whatever that looks like for you to get in your home, which means that if we have to refinance a car and I send you back over to the banking side, hey, let's refinance that car and get it down $200 to $300 so that we can help with debt to income ratio. That's what we do. If we looking to do a debt consolidation to pay off some of that debt so that we can get you a higher purchase price, that's what we're looking to. It's a case-by-case basis, and that's what makes it more of a community-based institution, so that we can not just take an application, but help you financially along the way. So getting into the slide, pros and cons of owning a home, your long-term value of ownership, the ability to repay your mortgage. And like I said, we're going to talk about that when we're talking about savings and budgeting and debt to income ratio. That's where all that comes into play. The responsibilities of owning a home, because not just you getting to your home, being able to keep your home, being able to budget so that you know some of those other things that you pay outside of what's on the credit report, that you're able to budget all that and factor that into owning a home along with having your mortgage and making your property your home. Of course, it's going to be your home, but all of the assets that you can gain, all of the deductions for tax returns, being able to add to your home. You can't do that when you have a rental, adding different things that you want to your home, painting, some people like adding a cemented driveway. These are things that you can do with your home and add value to it. All right, as we're gonna go to the next slide. All right, so that long-term ownership, the pros of it is, being able to add to that home, like I was saying, and increase the value of your home, which also helps. So if you're looking to only stay in that home 5 years and you want to sell it after 5 or 10 years, then you can add equity and value to it so that you can profit from it if you're looking to sell. Or if you just want to keep it and add more value so that you can have more equity in it, for things that you want to do. Like some people take money out of their home, the equity, and use it to start a business. So that's some things that you can do with it. Some of the cons is that depending on the market, the economy, what's going on with administration, the property value can go down just due to the market. So that's one of those downsides of it. But those things happen, and just like it go down, it can go back up as well. It can double in value. So it's not all bad for the property, the value to go down. I will say when your property value goes down, most of the time your property taxes amount go down, which can make your mortgage go down as well. So it's pros and cons to it. The ability to repay the mortgage, a portion of your monthly mortgage goes to the principal. And as you get closer to owning that home, that's when the loan to value changes. So the more you pay on it, if you're paying your monthly mortgage and you're paying a little extra, that helps your principal go down more. And we'll talk about that more, I think, towards the end. There's an end slide with that. Also, the con, you may need to make a large down payment up front. There may be many other home ownership costs. But like I said, we're a credit union and we're here to make it more affordable for you. So when looking at down payment, there's other options. And like I said, we're for the community to make it affordable for you. So there's ways around that. Some of your bigger banks, you do have to make a large down payment, which takes away from the money that you have saved. That's not what we're here to do. We're here to save you money and make you financially wealthy at the same time. Responsibilities of home ownership. Okay. Homeowners may be able to deduct mortgage interest, property tax on their income taxes. That's what I was saying earlier. So the interest that you pay into it for those 12 months each year is going to add up, and you're able to use that as a deduction on your property taxes when it's tax season. If you're single, a lot of single people, they actually are able to get more out of their deduction when they have a home. You know, if you don't have any kids and anything else to claim on your deductions, a home will actually help. So you don't end up owing the IRS. So that kind of helps for you. And some of the cons is what we talked about with the property tax, the insurance, home maintenance. Those are things that go into purchasing a home, but we want to make sure that you understand that at least 1 to 2 years before it's time to get into a home, so you understand and have the expectations of what you're coming into. And that way, if you have the expectations, you know what to save for throughout the year for home maintenance, you know, plumbing, cutting grass, that gets expensive too. Landscaping, just wanting to add to your home, all that is expensive. And you don't want it to take away from you being able to pay your mortgage, but you want it to be extra things that you can do. So that's what we'll talk about, that saving and budgeting. Isaac, you can go to the next. I do see some things in the chat, so I'm not real sure if someone has questions.
Perfect. So we have a question. Am I able to come in and have an in-person sitting with you all? I researched your location and I saw that you were in the area. Love this question. Love it.
Yeah,
absolutely.
For sure.
And that's why we're so happy about our grand opening in Roebuck, because now it's more centralized and you can come in. It's a brand new renovated place. So sure, we want you to come in. This is for the community. It's for you to come in. So you just reach out to me or Tanisha and you can make an appointment and we'll make it happen for you.
Excellent. Great question. And again, if you may say, Isaac, I'm traveling right now. I can't type my question in the chat, but I would love if you could I'll raise my hand. And if I could voice my question, you have that opportunity to do that. So there isn't a dedicated, question at the end, section. It's like, throughout this is more so a conversation that is guided by a presentation. And so this is a group dialogue in which we're able to learn from Sharonda and Tanisha on best practices. So make sure you ask your questions, because I'm about to ask one here shortly. So what y'all think about this 50-year mortgage? What y'all think about that?
A 50-year mortgage. Well, it makes it a whole lot cheaper. Now, there may be some pros and cons to that too. And it always is, but the longer you have on a term on a mortgage, the cheaper your monthly payment will be. So I will say that in general on that.
Mm-hmm.
And a lot of times I've seen a 50-year, it could go up to a 50-year on what we call a modification, but that's when someone gets in trouble, and we want to help you not get to that point where you have to do a modification. But on a 50-year, if you're coming in with a 50-year, I would say it's great.
Okay.
The only other thing I would add to is just be mindful of your age. And, of course, we all want to live long, healthy lives, but sometimes I would say be mindful of your age and just know that after you hear, someone else is going to have to take on their 50-year mortgage too. So
that's good.
The good thing about that, the good thing about that, Tanisha, is if they come in with a 50-year term, they can always refinance down to a 30, a 20, or 15. So it's not set in stone. It's just to get you started. If you want to go on a 50-year for a lower monthly mortgage at the beginning, that's no problem. And you're coming up on a more money and a promotion, and then you can pay more on your mortgage. You can always refinance to a shorter term. That shorter term will make it go up a little bit, but at the same time, it's a shorter term.
Excellent. I know that we have all seen some aspect of activity on our timelines around this 50-year mortgage. And so I'm pretty sure folks are seeing the number, but not necessarily knowing how to process what it essentially means. Again, we're not saying that it is a fact, but it was a really good educational moment to talk about the longer the term, the lower the payment. But again, the goal isn't to necessarily take 50 years, right? Like the goal is to more so leverage the opportunity around cash flow and take it from there. So excellent. Thank you so much. And then I'm going to share this one last question that's in the chat, and I'm going to go to the next slide. Because also because no, she's just making a statement. Thank you. All right, great. I'll let you keep on going.
Okay, so some of the common terms, and sometimes I'm just going to get you to slide on by these because they're just really some of those terms that we're using, and I'm going to use them throughout the presentation. But of course, income. Let's talk about income quickly because a lot of people don't know what income you can use. You can use alimony, child support, disability, social security for yourself, social security for your kids, pension, retirement, all those things can be used as income as long as it can be documented. However, on that child support, the kid has to be 15 years old or less, right? Because we have to show a 3-year continuance. So, and that's actually on that social security that your kids receive off of you or benefit from another adult, they have to be at least 15 years old on that income. So income history, we're talking about alimony, child support. You do have to show me that you have at least 6 months of continuous payments that you received in the last 6 months in order for me to be able to count it to know that it's stable income for you. All other income history, talking about employment, we have to show at least 24 months of income. I know a lot of people are concerned about switching jobs in between the year, and there's ways to get around it. So what Hope does is we look at the bigger picture. So if you've moved jobs within, 2 to 3 jobs within 2 years, that's not a big problem. The problem comes in is if your income changes from 1099 to a W-2. Then I don't have a good way to average out your income over 2 years, right? We want to see the same type of income for the last 2 years. So W-2s for the last 2 years, 1099 for the last 2 years, self-employment last 2 years. 1099 is considered to be self-employment. So both of those are kind of one and the same. And we do have to see your income tax, your tax returns if you do have 1099s, because it's considered self-employed income. And so, we take an average of the last 2 years of your income. So whatever you're stating on your tax returns, if you're self-employed or 1099, that's what we're going to use. And that's also why I, want people to come and start looking into their income a year to 2 years before, because a lot of people, they file deductions, and sometimes those losses can decrease the amount of income that I can use on my end to qualify you. So if you have, if you do your own taxes or you have a preparer, make sure to let them know 2 years ahead of time. If you're starting, let's just go back 23, 24, that would be the time that you wanted to look into having yourself making more money. Otherwise, you would have to amend your taxes. That could be crazy in itself with what we have going on with government and things like that. So you just want to take time to make sure you have your affairs in order before you're ready to purchase a home, because we have to do what we call an income analysis on those tax returns. Any losses that we see, we use that to deduct from the income that we can use. So that's very important. A lot of self-employed people, those are really the people I like to see a year to 2 years before, because it could be very disheartening when I tell you I can only use $700 a month for your income, and you make $5,000 a month. So I definitely self-employed people are the people that I like to see mostly. Let's see. Debt to income ratio. Go ahead.
We got a question in the chat, and you touched on it, so I think this would be really good to expound upon. Does it have to be child support payment proof through the court, or can personal transactions be used?
Okay, that is a great question. Personal transactions can be used. However, there has to be a court document. So like if it's court documented and it's not coming on like the little benefit card, or it's not automatically coming to your bank account, we have to show where that parent is paying you a pattern each month, and pretty much has to be the same amount to kind of know, or that amount on the court document to make it, be the true child support. It can't be where they're just giving you money. It has to be an order pretty much to be counted.
Okay. And then in regards of income, and so just as you mentioned, there may be folks that are you may have a few educators that may be doing some work on the side. They may, I was about to give some examples, but I can't think of any. But ultimately, they may be receiving some money through Cash App, money through PayPal, money through So are they able to still reflect those types of deposits as income?
They can, and we do look at Cash App, Venmo. If you have a statement, we can look at those. The thing is, that money that you receive does have to be it has to go to tax returns. Like, you have to report it for me to be able to use it as income. It can't be that you say you have a business and you're getting money, but you're not, reporting it. It has to be reported. It has to be documented. I know you're saying document with the Cash App or Venmo statement each month, but it also has to be reported to the IRS for me to be able to count it as income.
Okay. So I think alongside that, and we've all been in situations where you may receive money on Apple Pay, and that Apple Pay money is never deposited into your bank account. You just expense that money out through Apple Pay. And so really there's no home for it, right? To be able to reflect what actually occurred. So just as, and this is a theme I'm picking up, the number one thing you want to have on your side is your paperwork. So a paper trail is very important, even when it pertains to taxes. Like, okay, it's good in regards to the refund, but we want to make sure that we're resourceful with what we have for the future, and the way that we reflect our income is very important. So thank you for that.
Yeah, at least filing it on your tax returns. That's the biggest thing. I mean, we can always show a statement from Cash App, Venmo. I'm not real sure about Apple Cash. I don't deal too much in Apple Cash. But if there's a statement that kind of helps add to it to make it, more stable, but it has to be reported on your tax returns. That pretty much is the end all be all, to be honest.
Excellent. All right. Next slide. Are you still on this one?
Next slide.
All right.
Credit score. We're just kind of go over. Credit score is not the all be all. Yes, it's a score. For Hope Mortgage, the minimum score is a 580. We pull a tri-merge, which is all three credit bureaus, and we look at the middle number. Okay. But like I said, score is not the all be all, because we look at, collections, charge-offs, things like that. So we'll get more into that, I think, towards the next slide. But the credit score is pretty much your score that you have from all three credit bureaus, and we take the middle score. A down payment, like I say, we have a more affordable housing program that we try to get everyone in. Now, everyone has a different situation, and everybody can't get the same type of loan, but that's our in-house go-to that we try to get everybody approved for first, right? Because there's no private mortgage insurance, there's no down payment. So the affordable part of it is truly the affordability of getting you in the home and helping you keep money in your pocket, long-term and short-term.
Okay. Yeah. If someone is sitting here and they're like, man, I got a 590 credit score, I don't even know why I'm here. What's your response to them?
Well, you could be here because you have a 590, but you have a recent collection. You have a recent charge-off, right? Or it could be a 590 because you don't have anything on your credit, maybe a medical bill that pushed it to a 590. However, we'll take that, but then I need other things to show that you have a positive payment pattern or history, which means that there's nothing on your credit but a medical bill, but I have to show that you have at least 4 things open with 12 months of positive payment, consecutive payment history or payments, no lates or anything, and that can be utility bill, insurance, car insurance, life insurance, storage, gym membership, you name it, we can take it as long as it can be documented and show that you have 12 months of payment history.
Check that out now. Check that out.
A lot of bigger banks are not going to do that.
There we go. There we go. So I just want to make sure we call that out, because somebody may have went to whatever financial institution, I'm not even going to name examples, and they clicked mortgage and they saw a number and now they stop. And so I want to make sure that everyone that is listening to this, watching this, It don't matter where your number is now. They kind of do. You don't need to be in the 370s or something like that. Like we got a little bit more time to work on that. But it don't pretty much don't allow the credit score to be the number one indicator if you can participate in these types of products, because that's just not a part of the full picture, right? It's just a piece of the picture, but it's not a part of the full picture. And typically at larger banks, that credit score is the first barrier to even see if they can even welcome you, right? Even to see that you'll get a peppermint once you walk into the bank. So, excellent, excellent, excellent. Anything else before we move to the next slide? Let me check. We got some things in the chat.
Yeah, Katie was asking a question. She wanted me to repeat that. So again, if you, let's just say everybody's situation is different. Let's just say you have nothing on your credit. You don't have a credit score at all. We take that as well. So if you don't have a credit score, we'll just need those 4 things. And like I said, it could be utility bills. So we can put water, Alabama Power, gas, what else? Cable bill, Spectrum, a cell phone. If you can show me 4 things that has positive payment history, meaning you have not been late on those. And let me say this too. You can be late on it by a couple of days. You can't be 30 days late. Because we're going to do a verification with the creditor, right? And we're going to call and we're going to do a conference call. And if they say that you were 2 or 3 days late, we don't report that. But if you're 30 days late, we have to report that to the underwriter that you were 30 days late. I'm not saying be late, but there's ways to get around it, right? But those 4 things do have to show at least 12 months of positive payment history. And it has to be 4, especially if you don't have any credit score and you don't have anything in your name. Now we do take rental income. The rental income we can use, I said we have to have 4 things. So let's just say you have Alabama Power, you have water, but you don't have anything else. We can do the rental income of 24 months and that counts as 2 trade lines versus just 1. So the rental history is the only thing that we can give you 2 trade lines in 1. As long as it's 24 months of positive payment history. Same thing goes if you were, like landlords, sometimes they'll give you up until the 10th they could charge you a late fee, but the 10th you're still paid just a late fee. You're not 30 days late. As long as you're not 30 days late, then we're okay.
Excellent.
I hope that answered your question, Katie.
Yeah, you also take subscriptions, paying those monthly, as well as like if they got something from Lowe's or Home Depot, they're financing appliances or something like that, you will take that as well.
So Tanisha, I'm so glad you brought that up. So let's kind of talk a little bit about Afterpay, Affirm. Those things are considered debt, not positive payment history, right? So because it's a buy now and pay later. If you have those in your bank statement, that is considered debt. I would say try to pay those off before you even start to look at purchasing a home because it's considered debt. And I have to use that against your debt to income ratio. So those type of things, no. Yes, we can't do Affirm and things like that. But as far as subscriptions, let's just say you have Apple TV, Netflix, what are some of these other streaming, Hulu? I can and Microsoft, I know Xbox, things like that. I can use at least one of those as a trade line. Only one though. They will not let me use more than one. But it can be used as a trade line.
This is
excellent.
Oh, y'all, I want to do the Tootsie Roll because this is a thing, the Affirm, the buy now, pay later. You like, oh, that's not, and then next thing you know, you're looking to buy a home, and now that impacts your overall ratio and how you receive at the bank. So it may be easier to, put that purchase into $75 payments. But at the same time, look at what you are preventing for the future by knowing how these types of transactions are categorized. And so that's really good information because it's so easy these days. Instead of hitting checkout now, you got the little Affirm option right there, and you can say, yeah.
Well, that's financing. Yeah. So
that's
financing is like that. It's buying now, but some of them put interest on it as well. So it's truly a debt. And the other thing is, I just had a customer that bought a airline ticket, which was almost $2,000, and she was paying like $150, $175 to pay it back every month. That is added to what we call your housing ratio, which is the part of your debt to income ratio. And so we're looking at whatever you're paying monthly, even though it's not on your credit report, it's on your bank statement. And so that's the debt that we found, and we have to add that in, and that can affect your debt to income ratio.
This
Even
is
just an
good.
extra $150 a month can affect your housing ratio.
This is good. This is, and again, unfortunately, Sharonda and Tanisha, whenever they go through the process through a firm or whatever it may be, they're thinking the pro is, well, it's not going to show on my credit report, right? I'm good. Nobody really knows but me and this company. But lo and behold, as you look to get additional products like purchasing a home or a car, and you have to use that same type of financing strategy, because just like Sharonda said, hey, it's debt at the end of the day. That ain't your money. You're using somebody else's money and you paying them back on a different terms. So this understanding and awareness, if you're like, look, 2026, my goal is to become a homeowner. Let's go ahead and start weaning off these affirms. So by the time they can look at your bank statements, it properly reflects the cash flow that is coming into your house, and also what's coming outside of the house. All right. Love
So I
this.
will say this, when it comes to bank statements, choose wisely which one you show me. You got some where you got your income coming in, and you probably got another account where you spend everything out of. That one that you spend everything out of, I probably wouldn't want to see that one. Show me the one with the money coming in. That way we can kind of prevent that situation, because yes, they look at things on the bank statement. I know some people have more than one bank statement, so just choose wisely which one you show me.
That's right. Treat bank statements like taking a selfie. You know what I'm saying? You want to make sure you got that good light before you go ahead and okay. All right.
So the 5 C's of credit, your capacity of that's what I was talking about with coming to me 1 year to 2 years before it's time, so we can see what your capacity is, how much debt you have. Maybe you have to pay some things off before you get into this home. Or maybe you have some things that you don't want to pay off, but then it's going to limit you to how much you can get as far as your purchase price, because it's going to depend on what your debt to income ratio is, with adding whatever the mortgage amount will be to the debt that you already have. So your capacity, how much you can afford with the debt that you already have. Your capital, how much you have bringing in, your savings, your checking, investments, your inheritance. Grandma and granddad may have money for you that you have. It may not be liquid, but we can use it as reserves for you. Your retirement, your pension, whatever you have in there, whatever the value is, as long as you can take it out or withdraw it when there's emergencies and things like that, then we can use it. Now you got some I think like the state of Alabama employees, they can't take theirs out until they retire or until they're 59. Right? Or they leave the state of Alabama. So those we can't count as reserves. And I'm sorry, I've had a lot of people to come to me with their pension. They can have $50,000 in there, and guess what? I can't use it because they can never withdraw from it. The whole point of capital is to show that you have money to fall back on, just in case something happens or you lose your job. There's emergency, a medical emergency, terminal illness. At least 3 to 6 months of money saved up will allow you to keep your home at least 3 to 6 months until you figure the rest out, right? So that's what that capital is used for. It's not that I want to see your money or use your money. I just want to know you have it to fall back on. Collateral is the property that we use to secure the loan for you. So I can't just give you $100,000 without a property. I mean, that'd be a personal loan, and I don't do personal loans. So I definitely have to have a property. We don't do land. I know that's a question for a lot of people. Land is done, but not on my end. Because land is considered raw with no property, so I can't do it. But I think, Tanisha, there are some products out there where you can purchase land. Okay? And character. I don't really, we can look at character, but people go through things. Life happens. So I can't say that I'm going to look at black and white and know your character. I just want to know your story or what happened. That's why we do letters or explanations when it comes to certain things. So let's just say you give me 2 months bank statements, and one of those months you were in the negative. Okay, do me a letter explanation. Let me know what happened. Maybe you had car repair. Maybe your child, something happened and you needed to pay something for your child. Anything can happen. So when we look at character, we look at the story, what happened, so that I can relay that to the underwriter. And our underwriters look at the story. They don't look at you just by your credit score or by your credit history. They want to know life, really, like truly what's going on in the community, because we're trying to help you build that wealth and not keep you from it. All right. Conditions, the purpose of the loan, the factors, things that may affect your ability to repay back. And so what, on our affordability program, what we do is we try to keep your debt to income as low as possible. Like, let's just say FHA allows you to go up to at least 57% debt to income ratio. For a lot of people, if I went over 50% of their income to get them in a house, they'll probably go foreclose within the first 6 months. We'll say the first year. Because if you're looking at spending 50% of your income goes to your mortgage, don't let nothing happen. Emergencies. So then you're taking from your mortgage money, you're taking from your bills, you're taking from anything else that you have, insurance and things that we don't see on that credit. So that creates an issue for you and puts you in a situation where you can lose your home. So what we do is we try to keep your debt to income ratio under 50%, really under 45%, more like 42%. That's to help you keep your home. So that's some of those things when it comes to affordability, repaying back. That's what we look at. I try to help you keep you in your home, not help you get the biggest house and foreclose on it in 6 months.
Absolutely. Absolutely. And for those that are joining us, if you could drop in the chat, if one of your goals for 2026 is that, hey, I actually want to become a homeowner by 2026, please drop in the chat so we know. We want to make sure that you have the immediate information to be able to follow up and any questions that you may have. Because if there's any takeaway that you have that this is the one that I'm walking away with, is you never know. And the best thing you should do is to reach out to Sharonda and Tanisha to see if you are in a position to start the journey for home ownership. And if not, knowing what steps that you need to take. Okay, we already got someone. 2026 is my year. We're going to make it happen. We're going to make it happen. We're going to make it happen.
Absolutely. Absolutely. You got to start from somewhere. If you don't start from somewhere, then you're not going to know where you're going. So, let me be that person to get that game plan together for you. We do it together. We put together a plan. Like Tanisha said, if you're not ready right now, we're going to get you ready. I have had people to come to me 1 to 2 years. They're not ready, but within those 1 to 2 years, they're in their home, and they're thankful for that because they're learning as they go. They're getting their finances together. They're learning what and what not to do. They're not making big purchases right before it's time to get a home. So it's a lot of things that can help you get into your home. It's not a no, it's just a not right now, but let's help you get ready to get to that point.
Absolutely.
So you can be ready in 2026.
Come on now. It's going to happen. We're going to do the Tootsie Roll, and I'm looking forward to the housewarming party. You just tell me where my room's at. All right, let's keep going.
Yeah, so these are some of the things that we would go over, some of those needs and wants, budgeting, some of the things that you can cut out. Well, you got a lot of people who like to shop. They like to get the latest Jordans. I'm not saying this is a bad thing, but when you want a house, if you're putting away money for the Jordans, let's put away money for savings for just in case the pipes go, break or something, or appliances or things like that. So we just want to make you more aware of some things that we can do to help you financially healthy, not just to get into the house, but stay into the house and change those things that you're currently doing that's not helping you save and help you save more.
Excellent. And we have as any additional tools, sample spreadsheets with the formula in. If you need some help in regards of just putting together a spreadsheet, we got plenty of tools to be able to help support, because just as the team mentioned, we got to be able to make sure that we get the basics in place. So we got to know what's coming in, we got to know what's coming out, but also at the same time, we need to have a good understanding of, all right, what is it do I need to pay that if I don't pay, they're going to turn it off, right? What are some of those things that I've established as needs? Of course, groceries, things of that nature. But if you like, I probably don't need a DoorDash every day of the week, maybe just need to be 3 days out of the week. Whatever those experiences are, we may need to modify, because again, the process to be able to get approved for this mortgage is going to require work. That's why Sharonda keeps pointing out, let's get ahead of it. Let's start early. And so the quicker you can start making these adjustments, the quicker you can appreciate the sacrifice and not feel like you got to eat ramen noodles or sleep in your car to be able to buy a house, right? So it can be done. We just got to make sure that we're first aware of how you're moving your finances, and then we adjust once we increase our awareness. All right, we got a few things in the chat. All right, here we go. Oh yeah, they trying to get the name of the credit union. They finna track y'all down. Yeah, Hope Credit Union. This is it. Hope Credit Union. And we're gonna make sure at the end. So stay to the very end because the direct contact information is gonna be there. So for you to be able to reach out to Sharonda and Tanisha. And so let's make sure that, as the young folks say, let's keep this energy, right? Like, let's make sure that we use this information, but also we share this information so we can make sure we have more homeowners next to us, because we've all been next to a neighbor that's renting their home versus someone that owns their home, and the level of care typically is a little different. So the more homeowners you got within a community, then you can really see the benefit of community, because you're able to stay within each other for a long time. All right, let me get off my rant. Let's keep on going.
And to add to that, Isaac, the more homeowners in the community, the higher the property value goes up.
There we go. There we go. Come on now. Let's make it economic. Love it.
We already talked about this. We're going to go skip on to the next one. I don't want to hold y'all all night.
Yeah, all right. All right. Hey, we need paper trail. Paper trail.
So I saw student loans on that. Let's just say, okay, student loans, that's been a big topic too. There has been some changes with the administration towards the beginning of the year, where a lot of people were on different income-driven repayment plans. They were changed, and some of the people didn't know that they weren't on an income-based repayment plan. So then their student loans went into default. Nothing we can do about that once they go into default. But what I would say is just go ahead and check on the status of your student loans. If you're on an income-driven repayment plan, see how long it's in effect. If it's for the next 12 months, that's fine. If it's a $0 payment, or if it's $25, whatever it is, we can use that as long as it's going to be effective for the next 12 months. If it's going to expire within the next 3 months, we probably can't use it. And unfortunately, we will have to use that debt against you, that student loan debt. So let's check into those student loans, see where they are, make sure they're not default, see what your payments are. And if you can get on an income-driven repayment plan, see what type of plan you can be on. That way we don't have to use that full amount against your debt, and then it takes away from your purchase price. Because I want to get you as much as you can afford, the ability for you to afford, and not use student loans against your credit.
That's good. That's good. And if they're especially for our educators, if you need some additional help, one of our first workshops was with Megan McGuire. She is a certified student loan professional, one of the few across the country, and she will be able to help you step by step with your situation. You'll go to studentaid.gov, pull your information. If you need to change the type of payment that you have, or the type of loan that you have, to get it updated, to Sharonda's point, to better reflect with the adjustments that the government has made to the forgiveness, to the public service loan forgiveness, to the IDR that was just adjusted. So there's been some adjustments. So if you feel a little overwhelmed with that step, reach out to Megan McGuire. We will cover that time and cost to be able to have that one-on-one session. So whenever you do connect with Sharonda and team, you are already positioned, and you have the documentation to best reflect how that loan can be reflected to the underwriters in the future. So this is really good information to know.
And so, like I spoke on the student loans, what affects your credit, student loans definitely can. When they go into default 30, 60, 90 days, they're pulling and dragging your score down. You can start with a 640 and end with the 530. I've seen it just from student loans. So that and late payments. So let's just say you got a credit card and you're not even making the minimum payment and you've missed 30 days. That 30 days can take you down 20 points, and you can pay it and get it back to where it's not default and it's current. But then how do you get those 20 points back? It's very hard to get them back. You can pay the credit card off and it's still, they're probably going to give you maybe 7 points back, but you lost 20. So it's just hard to really get those things back. So at least make your minimum payment on your credit cards. loans, different things like that, just don't be 30 days late. And if you know you're going to be 30 days late, call the creditors, see what they can do. Sometimes they have programs where they don't have to report, they give you time to make that payment before they report out that you were late. Amounts owed. So credit cards, if you have a high score, high limit, and you have a high balance, then we need to look into getting that balance down. So you got a $10,000 limit and you owe $10,000. Yeah, that's going to bring your credit score down. What you want to do is the rule of thumb is 30% should be your balance of the credit score. The credit limit, I'm sorry. But what I would say is 20 to 25%, you know. Let's do that to give you leeway just in case you have to use your credit card for emergencies, because we know life happens. So I would say at least keep those down to 20 to 25%. 30% if you just, you can't do that 20 to 25, but keep that balance low so that your score can stay going in an upward manner versus going down for a high credit balance. The length of credit card, I'm so sorry. That's the Pomeranian. I'm so sorry if you hear me back. He must hear something.
I'm pretty sure we got folks that got kids in the background saying, "Mama, I'm hungry." So I think everybody can relate to a little extra noise. We'll just act like it's a pandemic and everybody at the house. Right?
Yeah, he just real rude though, so he real loud. He give me anxiety, so I hope he give y'all anxiety too. So we want to talk about the length of credit. The longer you've had a credit card, the better it looks on your credit report. And so it's not for you to go out and get several different cards, but if you have that one good card that you use and pay it on time and keep the balance down, that'll help your score increase as well, because they look at the length of time that you've had your credit cards. Types of credit that's used. So it's always good to have a variety of credit. So like I said, not a lot of credit cards, but have your credit card, have your little loan here or there. Major credit cards are good. Not a lot of retail credit cards with high interest rates. It's just good to have a variety. A mortgage, installment loan, which could be, student loans and auto loan, and then your credit card. You don't need a lot, but just having a variety also helps too, with the full makeup of your credit profile and your report. New credit, if you have to get new credit because you don't have any credit, it's nothing wrong with having secured cards along with unsecured cards. And the difference is the secured card, you're going to put your money on there to build your own, to build your credit card. And usually if you do good with that, you get your money back and they actually give you your credit card, and it becomes an unsecured card where that's the money that belongs to the bank that they're giving you credit for each month to use. Right. And I think that our banking side has a lot of good products to help you build credit if you have to get an unsecured card. And they also have different loan products. Do you want to speak on that real quick, Tanisha?
Yeah, absolutely. Like Sharonda said, we do have credit building products. One of those is called the Borrow and Save loan. It's $1,000 loan, but you get $500 up front, and the other $500 goes into a savings account. You pay on that loan. I think the interest rate is about 12%. So your monthly payment is $80 to $90 a month. You pay on that monthly to get that loan paid off within a year. We're sending those payments to the credit bureau each month. So you're showing your on-time payments. And then once you pay off that loan within that year, that other $500 that's in your savings account is you have it at your will. So you can do that. So that is kind of to help alleviate you getting another loan. That $500 that you saved is now yours, and you can use it so you don't have to get another loan. So it's kind of to stop that revolving door of those payday loans. Get the Borrow and Save loan. And like I said, if you're making your on-time payments each month, that's building your credit. Absolutely.
Thank you, Tanisha. So credit is different for everyone, and it just depends on your situation. What you do want to do before deciding to purchase is just look at your credit score. I know that Isaac has some different resources that he can provide. What we normally go to is what you see here, myfico.com, and also annualcreditreport.com. Those are two free ones that you can go on. I think you can get one free credit report a year and at least know what's on your credit. Some people are victims of identity theft and they don't know it. And most of the time it's the closest people to you that have done it to you. You know, I've seen that a lot. So you just want to make sure there's no, and the crazy part is it can be utility bills that someone got in your name. They didn't pay it. That's a collection. It goes on your credit. It affects your credit score. You know, just opening up credit cards that you don't know about and them using it, or they opened it up and there's an annual fee and that's being charged on there, that becomes a collection. So it's so many different things that can happen. Even just checking to make sure that your address is correct, your name is correct, your date of birth, those different things, they do matter when we pull credit to get your home. So just making sure all those things are correct. And if there's any changes that you need to make, usually the credit bureaus, their information is on there. You can call and put in a request to have those things updated. They may ask for some documents from you, but at least you're being proactive to make sure all that stuff is taken care of before purchasing a home. Because for me, I would have to do it on my end. If I pull credit for you and something is wrong, your date of birth is not matching up, there's an address that's not correct and it's not, you know, tied to you, but it's on your credit report. Those are things that we have to fix before we can even get you a pre-approval. So doing those things on the front end can kind of decrease some of that time it takes to get your pre-approval. Okay, and so just some things that determines the score. These are the credit bureaus: Equifax, Experian, TransUnion. Like I said, we pull all three, and who was ever in the middle score, that's the one we use. So we don't have a specific, we use Equifax or we use Experian. We're just going to take that middle score. So whoever your middle, and that's another reason why you should check your credit report before purchasing or coming to purchase a home and letting you pull application on you, because that way you can see what's your middle score. And if your middle score, let's just say you have a 600, a 560, and then we'll say a 500. So we know we got to get that 560 up. You can be working on that to see what's on that particular report. So bring it up.
That's good. That's good. And we definitely support My FICO, because that's one of the platforms that we've seen that's been the most closest to what underwriters see. Because they're like, I got credit-wise, I got the Experian app, and I didn't Experian, but like, yes, all of that could be true, but that ain't what they see. So myfico.com, that's probably going to be your truest source of information. And just as Sharonda mentioned, annualcreditreport.com, that will give you that full profile. And so this is excellent. We'll keep it on going. I may throw in a question as we get closer to the end that we had submitted. So there was a few questions that were submitted I want to make sure that we touch on. But I'm gonna let you keep rolling.
So down payment is, for a lot of lenders, they charge a down payment of 3 to 5%. Most of the time for your first time home buyers, it's going to be 3%. To help you get in your home. If you've been a home buyer before, a homeowner within 3 years. So like if you have been a homeowner and you sold your house, and let's just say 3 years down the line you want to purchase again, you're considered a first-time home buyer again. However, if you sell a home and you go right back to purchasing a home, then you're considered to be a previous homeowner. So most of the time, those lenders are going to require you to put 5% or more down. So the affordability program that we have, there's 0% down, even if you are a prior homeowner. So if you sell your house at the same time, go and purchase a house a month later, we're not going to charge you, as long as you qualify, we're not going to charge you 3 or 5%, 0%. A lot of banks aren't doing it.
Yeah. This is good. Yeah, we had someone say in their question, not a first-time home buyer, what are some incentives? And so I think, just being able to share that's good to know, because I know we got someone on our team that was a homeowner over 3 years ago and probably may have thought that, hey, I don't know if I could qualify for any of that. And so just hearing that there is a time frame with Hope Credit Union in regards of these type of additions and products, that's excellent to know.
Yeah.
Let me see.
And some other people may be on grandmother or mom's home on their deed. So if you're on their deed, that's okay. A lot of banks look at you as being a homeowner because you're on their deed. We don't look at that. We still allow you to go with the 100% financing if you're on the deed, or if you've been a previous homeowner within the last 3 years. Okay. So that's one of those incentives. You get to keep money in your pocket. You don't have to put down when purchasing your second or third home.
Right.
And of course, like Tanisha said, some of the lower interest rates that we have to go along with that. Okay.
Yep.
So just some of the things that when you purchase your home, miscellaneous costs, these are things that we will go over. So let's just say you did come to me a year or two before, you have the expectations, you save money, you budgeted, now you're ready to purchase your home. I will provide you with a fee sheet during the time of pre-approval so you can kind of see what some of the numbers look like. And this is what we call an estimate of those fees. This is not set in stone. So when you see those things, these are just kind of estimates of maybe a certain area that you're looking to purchase in, what the homeowner's insurance and the property tax look like in that area, just so you can have an idea of what your cost would be for whatever the purchase price you're looking for. Mm-hmm. And so closing costs and those things will come basically after you found a home and we provided you with your closing costs. You will kind of see but you will see your attorney fees and title fees and prepaids for getting your insurance and your property tax and an escrow to start off with. Those are considered closing costs. If you have a discount point, which maybe the seller wanted to pay extra to help you get your interest rate down, those would be considered closing costs. And all the closing costs would be shown on either a loan estimate or your closing disclosure. Basically, you'll see it twice during your approval process or your process for your loan.
Okay. See.
So this is what I was saying earlier about the affordability of what Hope provides. Let's look at Mary, 0% down, 5%, how much she's going to save. And then you have private mortgage insurance that a lot of lenders require. We don't require private mortgage insurance. That's another way that we make it more affordable. So the person who was asking about being a previous homeowner, there will be another incentive. A lot of your conventional FHA, they require private mortgage insurance. We don't. So that makes it affordable for you, even if you've owned a home before. Okay. Versus scenario B, putting $20,000 down and you've only saved $2,700 in interest, but you might have that private mortgage insurance. So you're still going to have a higher mortgage than scenario A. And then look at your interest rates. And I want to just point out, interest rate is not the all be all, because if you're coming in with a 5% versus a 4.5, but you don't have private mortgage insurance, but you have private mortgage insurance on a 4.5, it still can make your interest rate, your mortgage lower with the 5% because you have no PMI. So it's just a lot of different factors that go into a mortgage overall. It's different parts of it. You got your principal, your interest, your property tax, your insurance, and private mortgage insurance. And private, let me state this. Private mortgage insurance is to cover the lender, not you. It's an insurance almost like to cover just in case you foreclose or something happens to the home, they can claim the home back.
And we got to pay for it. No, we don't got to pay for it because we're going to go through Hope Credit Union. How about that?
That's right.
All right. And again, this if there's any brow raise, like, hold on, you telling me I don't have to put any money down? Like this, yes, this isn't in the next 10 days, you got to sign up. Like this is part of having a relationship with a credit union, specifically Hope Credit Union, to be able to know about these different products and also blind spots when it pertains to utilizing these products if you weren't aware of this information. All right, let's see. I think Sharonda may be frozen, so we may have a little bit of a buffer there. But as she comes back on, Tanisha, did you want to pick up here or
yeah? Hopefully she comes right back. Yep, there she is. Go ahead.
I'm here. I'm sorry. Internet issues. It went out. So sorry.
But if you can still
connect.
All right, perfect. If you can still see the screen, well, you can keep rocking and rolling, my friend.
Okay. So this is just some of the things that you will see that's included as your closing costs. So we do charge for the credit check. It's not upfront. It's only when you get ready to close on your home that it's on your closing disclosure. Inspection costs. Inspection is your let's just say termite, septic tank, and the seller is not willing to pay for that, then that's something that's on the buyer side and that becomes closing costs. Okay. Appraisal is what you would pay upfront. It's an upfront cost that you pay to make sure that the value of the home is there. And that's very important because a lot of times if the home comes back and it's appraised lower than what the purchase price is, then your realtor and you will have to go back and negotiate that amount with the seller because the bank is not going to pay or finance any home that's more, the purchase price is more than what the appraisal comes back as. So that's very important to know what the value of the home is, which is actually different from an inspection. A home inspection helps you to understand what the condition of the home is, if there's any mold, if there's any, the roof has a leak, any window panes that are broken, chip paint, those things is what the home inspection is going to let you know about the home. But the appraisal is strictly for the value. Okay. Earnest money, that's part of closing costs, but we give you credit for your earnest money so that, you know, and sometimes if there's a credit and it creates where you know you're not bringing anything to closing, but then you have a credit, you're able to get that earnest money back. It is a case-by-case basis, but that does happen where you can't get it back.
Right.
Yeah. So these are some more closing costs. Like I said before, tax, property tax and insurance has to go into your escrow. It's considered to be what we call prepaid because you're paying upfront on that closing cost or that property tax and things, so it can go into escrow, and then Hope Credit Union pays that every year, so you don't have to pay that out of pocket because it's part of your mortgage and it's going into an escrow. Just that part, that's property tax, insurance. We talked about appraisal, attorney and title fees, any government taxes is pretty much mostly going to be on your FHA loans. Our home affordable program, they have some state taxes, city taxes, but most of the time that's kind of all put in there, and you really don't, it really doesn't affect you, you know. So you can go to the next. We talked about private mortgage insurance, basically what it is. If you're paying less than 20% down, you have private mortgage insurance with most of your other lenders. With Hope Credit Union Home Affordable Program, you will not have any private mortgage insurance. It's not required.
What?
And so just a little summary, I'm just going to sum it up. When you're ready, just know that I like to see you. I say a year to 2 years. Sometimes, you know, maybe it's you only need 6 months. So, you know, 6 months to a year before it's time for you to purchase. Just make sure that you understand what you're coming into, the expectations of purchasing a home. We do require you to take a home buying class. I know that neighborhood housing services, they offer periodically throughout the year in-class home buying seminars, but we also have online seminars that we can offer you, but it is required to show a certificate for this program that you understand what it takes to get into a home.
Yeah. All right. As we can see, for those that have been just itching, like, boy, gonna get to that last slide because I need to call Sharonda and Tanisha to Ma. Here we go. Take a picture. And again, we are going to send over a copy. We'll send over a link with the copy of the video so you'll be able to hear the steps, hear the information. I would suggest before you reach out, make sure that you listen to this in its totality so you know how to reach out, right? And so there's certain information that you would already be aware of before you start asking these questions, because Sharonda really just shared with us what she is going to need to know to see if you are lendable. And again, it's not a no if it's not the right time. It's just not now. All right. And so let's be ready to take on that work. And we're very, very, very grateful for our guests that joined us today. And alongside that, we talked about the mortgage product. The beauty of this particular product are not necessarily having to come out of pocket, being able to circumvent the PMI. But as we've been able to hear, there are additional products that can get you in a lendable state. And so Tanisha will be able to support you with that as well. And I know that they have other team members. And so as you can see, the emails have just been dropped in the chat. Tanisha's email, Sharonda's email, alongside Tanisha's phone number. So make sure y'all copy that, screenshot that. I don't know how to copy and paste is on Zoom on your phone. It may be a little weird.
I was going to say, I think in my chat, I'm only allowed to send it to you guys. I don't know if someone else can copy it to the whole chat, where you can get our email addresses as well. So if you do need a one-on-one session, just shoot us an email. We can set up something where you can come to the branch. We don't mind at all.
Yeah, I'm about to put this number in right now because Zoom over here being all weird, like we can't copy and paste. All right, 3852. And for the additional questions, if you have any, this is the great opportunity for you to be able to reach out directly and ask those questions. I'm pretty sure that the team will be able to say, oh, you joined the workshop. So you'll have a little bit more love. You'll probably get a lollipop if you go inside. And so just make sure to shout out the Financial Freedom Project. I'm just being funny. Make sure you shout out the Financial Freedom Project so they know where you came from. And then also we'll be following up to see what type of wins we'll be able to celebrate together. I'm about to share screen to display the opportunity to be able to get feedback from you all. And so, as you know, after every workshop, we always have a QR code for you to fill out a survey. I'm seeing some names that have historically filled out a survey and got that $50 gift card. Okay, now we keep those consistent. So make sure that you sign up for this post-workshop survey. And then on the heels of this, our next workshop is actually going to be on investments. And so first QR code you see here is for the survey. A few questions, you knock that out, you will be entered to be able to receive a $50 gift card. And then complementing this workshop, we're going to start talking about how to get a first down with your money. And so there were a number of assets that Sharonda mentioned that could be used as a benefit when looking at your profile. And so we'll start talking through what type of money is mature enough to go into these assets. Because the last thing we need is for you to put money into something that's supposed to be for long term, and then 18 days later you need it for a credit card bill. Okay. Mm-hmm. So we got to have mature money there so we can make sure that, you know, we don't have to watch the money when it goes across the street, right? At some point, when you have kids, they can walk across the street because they have an understanding and they've been able to build up that trust, which means that came through some type of foundational work. So take a picture. No, don't take a picture. Hover over, hit the link to take you to the next steps, and then that should be good. Shout out to everybody that stayed on. Okay, let me see. Let me double check the chat. Yes. Has this been a good use of your time? Please share in the chat. Please, let's give everyone a round of applause. Tanisha and Sharonda, please share and let's definitely give them their thanks if you could before we close on out. And again, stay warm. This has been incredible. Every single time we do a workshop, I learned something. I feel like the last time we did a workshop, I became a client. So let me disclose that I have a banking product and I have a loan product with Hope Credit Union, and couldn't nobody beat it. So if y'all ain't gonna use it, I am. All right. So we get all the thank yous right there in the chat. Sharonda, thank you. Tanisha, thank you. I hope everybody has a great rest of the evening.
Yeah.
And we'll see you later.
Thank you, Isaac. We appreciate it. Thank you, Sharonda. Always giving us the knowledge.
Everyone. Hope to hear from everyone.
Absolutely. Thank you guys for joining us. Have a great night. All right. Bye-bye.